Good day! This presentation is all about sales management and discusses the role of a controller in relation to the sales department as well as typical kinds of analysis. Sales management. In simple terms, it is a process of creating a sales team, coordinating sales activities, and putting in place sales strategies that enable a company to yearly meet and even exceed its sales objectives. For instance, a sales management plan is a necessity if your company generates any money at all. So what is the role of the controller? As you can see, we have here the areas that controllers do in business. They are professionally charged with managing companies' finances and identifying how business has great power for them to be successful in their operations. Therefore, they both have a relationship with each other because without them, a business or a company cannot generate properly. Aside from this, I will discuss the sales analysis. From the word itself, it examines how well a firm's products are selling, particularly in comparisons to how the company anticipated they would sell. For instance, you may give your sales director a revenue target while giving your account management team a goal for sales productivity. It is crucial since it enables you to comprehend your clients' needs, the things they purchase, and the motivations behind their actions.
There are many types of sales analysis. We all know sales is the ultimate source of income for every business, covering all costs and expenses. That is why it is important to analyze patterns in light of previous quarters and or the connection to the budget, gross profit, selling expense, or net profit. Although many companies may use various types tailored to fit their organization, here are the some few common types that needed in sales analysis. First is sales trend analysis. This is the process of finding patterns in sales data collected over a specific period of time. For instance, a business may discover that one of its goods underwent a microtrend within the course of a week, with its popularity either increasing or decreasing. Second is sales performance analysis. This means that executives can use this strategy to find weak points in the company's sales to process and plan how to increase revenue and boost profit margins. Next is predictive sales analytics. In order to predict future dangers and opportunities, software is used. This method helps improve forecast accuracy and sales conversion. In that essence, the sales manager may discover that the controller can use some of these findings on a monthly or periodically. For instance, sales by salesperson, product line, or territory. It will also helpful to understand how it is important to financial. The deduction of sales in analysis is the significance of sales deduction shouldn't be understood in an examination of sales. Reviews may be related to net sales, however, deductions like excessive freight costs, special allowances, or discounts could be a sign of poor earnings. In a sales bottleneck, this is a part of the selling process that limits production. It is in the bottleneck where the sales slips away. However, the controller's responsibility in identifying these issues is to gauge each activity's capacity throughout the sales process and compare it to the volume of activity that actually occurs. Having the other uses of sales analysis, it will give benefit controller to perform correctly because the importance of sales analysis is the key aspect of running a successful business. Through sales analytics, you can decide which product to focus on, where to sell, and how to best to reach customers. Many sales analysis tools exist to help small business improve and grow their business. The next I discuss is sales standard. When we say sales standard, this is the controller's responsibility to provide the sales executive with sales data. As a result of the strong incentives placed on exceeding quota by sales executive and employees alike, it is not unexpected that there is a lack of consistency in the majority of sales organizations. Although sales standards are really applied consistently, they are a very helpful tool for creating and running a sales organization that can scale. These are the three primary requirements in developing tools for the sales executive. First is sales standards. It's the result of careful investigation and analysis of past performance, taking consideration expected future conditions. Sales standards are an indication of what individuals in the best position to determine what qualifies as satisfactory performance belief. Next is sales standards must be fair and reasonable measures of performance. The ability of managers to function as effective coaches heavily influences the fairness and integrity of act management processes. Lastly, sales standards will need revision from time to time. There will be times when sales standards need to be revised. Sales conditions are subject to regular change, thus the yardstick must also adapt. The illustration of sales standards is sales standards can be expressed in terms of effort, outcomes, or the relationship between effort and result. The performance of a corporation is greatly influenced by the measurement of sales volume of a firm. Monitoring this data helps improve operation in a number of ways, including determining which salespeople generate the most income, evaluating the performance of staff, and learning more about sales panel. Despite the fact that sales criteria can be applied to a variety of trades and sectors, given that opinions may vary, the controller may think about speaking with the following individuals about managers of sales. These are standards of effort, standards of results, and standards expressing relationship of effort and result. Standards of effort, it is used sales promotion to increase demand for their products and services, to improve product availability among distribution channel partners, and to coordinate selling, advertising, and public relations. Standards of result, this is a percent of potential customer to be sold to. As well, this is standards that prioritize achieving specific objectives without taking into account the action necessary to do. The last is standards expressing relationship of effort and result. This is the relationship between specific direct selling, cost elements, and revenue or gross profit. The effort outcomes concept assert that there is a cause and effect link between the management desired outcomes and the effort for the inputs. In conclusion, those three factors are all important. The importance of sales standard was helpful because having a standardized sales process adds structure and accountability to your sales activities, leading to a higher win rate and shorter sales cycles.
So sales report. When we say sales report, it is the collection of metrics and quantitative data and qualitative inputs that helps to evaluate sales performance within a team, region, division, or organization. It is also known as sales analysis report, which typically includes information on sales volume, leads, new accounts, revenue, and costs for a given period. Accordingly, the controller should offer to develop reports to meet individual requirements like the usage of charts, graphs, and summaries will greatly enhance the communication of the sales data to sales management. The matters that may include in sales report may cover any of these items.
Actual sales performance with month or year-to-date figures. Budgeted sales for both the period and year-to-date. Comparison of actual sales by firm with industry figures including percentages of the total. Analysis of variances between budgeted and actual sales and reasons for differences. Sales cost relationships such as cost per order received. Sales standards. Comparison of actual and quota sales by salesperson. Unit sales price data, and gross profit data.
So basically, product pricing is a process which entails the translation of product value into quantitative terms. In short, in the process of certain product will undergo calculations of raw materials. Pricing decision is usually made before its initial release to the market. However, a business can change the selling price at any point for a variety of reasons. Product pricing helps to establish a pricing policy that will be consistent with the corporate objectives, provide unit cost analysis which can be a key factor in price setting, project the effect on earnings and propose price changes and possible alternatives, gather pertinent information on competitive price activity, Analyze the historical data on prices and volumes to provide profitable trends, which also may influence proposal price changes. To that soon will determine the influence on profits of changes in price, product mix, sales volume, and others. Cost basis pricing. Over the long term, no company can sell all or most of its products at less than cost. Therefore, adequate cost information is indispensable. In the short term, the role played by the cost factors depends on the circumstances. For example, if a product is built to order, then cost will be more important. Furthermore, if competition is weak or if a company is the price leader, then constraint formations will play a larger role than if the opposite situations exist. For different purposes, different types of cost may be desirable. One type of cost may be suitable for a short-term decision and quite another type for long-term purposes. Moreover, for pricing, the usual historical cost approach may not meet the requirement. In short, the controller should be aware of the several costing methods and the limitation of each, and select that concept most suitable to the purpose at hand. Although many costing methods are in use, there are 4 approaches warrant discussion. First is the total cost method. Under this concept, the cost of the product is determined, and to this figure is added the desired profit margin. The total cost method has the advantage of being easy to calculate and being able to recover all the cost. The next one is direct cost method. This approach recognizes only the incremental cost of a product. These are the costs directly associated with the product that would not be incurred if the product were not manufactured or sold. If the product must be sold for its incremental cost or less, then the company would not earn less profit and might possibly earn a higher profit by not manufacturing and selling the product. Full consideration must be given, however, to the lost business if the withdrawal of the product would cause the loss or other business. Marginal costs are used for short term. The next one is return on assets method. This method maximizes the return on assets employed. It gives attention to the capital invested in manufacturing or sales facilities or working capital. This formula may be used to calculate the sales price required to produce a return on assets employed. Target cost method. This method is considerably different from the other costing methods. Target costing means that the new product design team determines the price at which the product must sell and then designs a product with a cost to fit that price level. In addition to the applicable cost, other factors in setting product prices should be summarized for management's review.
First, return on invested capital or assets employed. Second, assets employed and turnover. Third, percent of plant of capacity utilized. Fourth, percent of product line for each product. Fifth, percent of market. And the last, competition pricing and percent of market.